Do you get so worried about the market that you're afraid to spend your hard-earned dollars in retirement? Maybe a treasury bond ladder can help. Let me show you how to do it. Hi everyone, welcome back to your classroom. I'm Thatcher Taylor, the owner of ProPath Financial, and in these videos, I'm going to teach you how to have an optimal retirement. I have some clients that are coming into retirement and are in retirement, and they need to segment out some of their funds for short-term goals or even some short-term protection. So one thing we're doing is we're creating ladders to take advantage of the US Treasury rates. I want to show you my inventory, talk about how they specifically work, how the ladder works, and how this all plays into your short-term cash strategy. And at the very end of this, we're going to talk about what US Treasuries are and how you can build out this strategy on your own. Also, really quickly, I am accepting new clients. So if you're curious about how this works and how I help clients build for retirement and execute during retirement, go ahead and click the link below. I'll be happy to chat with you. If you're over the age of 50 and retirement is on your mind, I might be the person for you. The purpose of all this is if you use a lot of invested assets as an income distribution strategy in retirement. If you don't have really much fixed income or guaranteed income, this may not apply because you have guaranteed income, but if you still have short-term goals and guaranteed income, this could fit in. But I'm predominantly focusing on if you have big investment buckets that are going to be used to distribute income to you during retirement, this could be a big important feature that you could utilize. Lastly, before I pull up the screen share, this is not a recommendation. I'm not telling you to do this. I'm just giving you the tools to make decision on your own. Make sure to consult with your own financial advisor, financial planner to make sure this fits your particular situation. Now, the screen share. All right, so this is my bond inventory that I have with Charles Schwab where I custodian all my assets. My business does not hold any client assets. They're all custodianed at Charles Schwab and I just get paid a management fee, usually based on the assets that I manage. Now, a part of that management strategy is cash management. We take a bundle of money, we want it to mature in 2 years. We take a bundle of money, we want it to mature in 3 years. Or you take a bundle of money, you have a goal in a year, take that money, set it aside for that goal. Or you have a goal in 2 years, or you have a goal in 3 years. So you can utilize these, but some of these rates look interesting. So right here you can see under bonds, US Treasuries. Let's just look at the 2 year, because a lot of these are very similar. But let's look at this top one right here. You can buy this first US Treasury that was released on October 14th. That's when it matures. So it's a 2-year bond. Its coupon is 4.25%. Again, here's the maturity, October 15th. Its price is at $99.35. And its yield to maturity is 4.6. So that's interesting. This YTM or yield to maturity is more than the coupon rate. How could that be? Because if you take money and you buy a bond or a lot of bonds, they are issued at face value of $100. So these are trading at a discount. At maturity in 2 years, on October 15th, you're going to get the full face value or $100 back for each bond that you purchase. So you're buying them at a little bit of a discount. They're on sale. So you're actually going to get in maturity a little bit extra. It looks like about 65 cents more for each bond. That means the yield is actually 4.617. The coupon is 4.25%. That means throughout the life of holding that bond, you're going to get 4.25% a year, and that's paid semi-annually. You can see that right here where it says semi-annual. There's some other ones in here. You can see 4.25. Here's a coupon of 5%. And here's a perfect example of the yield to maturity is 4.61 because this particular bond, it matures on the 31st of 2025. It's not trading at a discount. It's trading it over its face value. That's why the yield to maturity is a little bit less than the coupon. So you're only going to get at maturity $100, not that 69 cents, but you're going to get a bigger coupon. This is a perfect example to show the teeter-totter, how it works with particular bonds. This is just the inventory and how they break down and some of the elements. So you can get these in year, 2 year, 3 year, 5 year, 10 year, 20 year, 30 year to build out your income distribution structure or your ladder structure for your bonds. We should talk about taxation. These are taxed at the federal level, but there's a state and local tax deduction where that interest earned is not taxed at the state or local level. So you need to make sure that if you're utilizing these US Treasuries in a ladder or in any format, that they're in taxable type accounts, individual accounts, joint accounts, brokerage type accounts, or trust accounts. Because if they're tucked in an IRA, everything that happens within the IRAs or 401ks or Roth IRAs, that's all tax deferred. So if you're getting these tax advantages within a tax deferred account, they essentially mean nothing. So you want to make sure these are in a taxable account. So there's essentially a few reasons that you want to do this. I'm going to break it down into three. One, this is part of your income distribution strategy, and you want to set aside some assets to let your investments operate and function, especially in down markets. If there's a year or two where the market is struggling, you don't want to have to sell off invested assets to supplement your income. You can put some of these ladders on the side to make sure you have enough income no matter what. And then if the market does well or your portfolio does well, you can harvest some of the top, repurchase things like this to take advantage of rates to make sure your dollars are there in the future. The second reason, if you're getting more specific, is that you can actually use the bucketing strategy for an income distribution strategy in retirement, where you bucket out 1, 2, 3, 4, 5 years of income, so you know you have that money set aside and you're going to be able to utilize it. So then the investments operate in the background. Now the problem with this is if you bucket too much, you're not getting enough growth on the assets overall to make sure that you have enough towards the end of your life. But this is a strategy that you could use US Treasuries for. And then lastly, US Treasuries are just a great place to be able to put some money if you have any short-term goals, like you want to buy a house in retirement, or you got a big trip coming up, or you just have money sitting aside that you don't want any risk going against. So you can just put in a US Treasury and let it operate, and then when it matures, you'll get your money back. We haven't really discussed this, but I want to talk about the time frames for US Treasuries. Usually the word T-bills means US Treasuries that mature in 1 year or less. Notes or T-notes are usually 2 years to 10 years, and then actual bonds usually come in the 20 to 30 year range. You can double check that by going to treasurydirect.gov. If you want to purchase all this stuff on your own, you can do it in treasurydirect.gov and see what the inventory is and purchase them yourself with your own account. Here's how you need to build this out. First, you need to find out what your income needs are. You want to get pretty specific. If you know next year you're going to need $65,000 of income, you want to make sure to go put that in maybe a 1-year treasury. You can take $65,000 plus some inflation and put that in a 2-year treasury. And then you can take a $65,000 plus maybe 2 years of inflation and put that in a 3-year treasury to make sure that's all set and ready to go, because you want the remainder of your assets to be built in a long-term portfolio that's going to help achieve your long-term goals. So make sure to sit down and double check on a budget. Make sure you know the actual numbers that you're going to need for retirement. Next, check and see if you have any short-term goals. Maybe you're going to need a roof. Maybe you want to buy a new house. Maybe you got some emergencies coming up in the future. Maybe there's some college that you got to pay for. Try to nail down those numbers so you can add those into the T-bills as well, because you don't want those short-term potential cash flow needs to be subject to market fluctuation. Once you get those numbers, then you can buy the T-bills. They're usually pretty simple. They don't really cost anything, especially when you purchase them through me. There's no fees. So we can build them pretty easy. Now you can buy them and just hang on to them and make sure that you track them on your own or with your advisor, and then make sure the rest of your assets are built for long-term goals. Because over the long term, really high quality investment portfolios do seem to do really well. I hope you enjoyed this. Please make sure to like and subscribe. Thank you so much for watching. There'll be more videos coming soon, and make sure to tune in every week on Friday. The Functional Retirement Podcast comes out with really great episodes. We do a lot of stuff like this, but more in long form discussions. So hope to catch you there. Please make sure to like and subscribe and hit me with any comments. See ya.